All right. Hello and welcome to the midweek update. Today, what we're going to cover is September 25th. It's myself and Mike Olafson with Invest with Rules. We're so happy you're here. Very important topic is risk management. We're going to talk about trailing stop losses. It's an incredibly important topic to manage risk, and that's what we're going to dive into today. Before we do, world's quickest disclosure. This is just information, not a direct solicitation to go buy or sell anything. So please always manage your financial plan, manage your risk tolerance. You know the dance. Today, we're here at Invest with Rules. So again, thank you for your time. This is for self-directed investors. The absolute mission that we're here for me, for you, for Mike, for our families, is to follow the trend, follow big money, and follow risk management rules. If you find, unfortunately, that just time has just gotten in the way where you don't have the time and availability to follow the process, we're here for you. You can email us at either hello@investwithrules or hello@IWR Advisors. Mike, welcome. How you doing?
Excellent, excellent. I'm so honored, Scott. You actually brought me back. I
Yes.
feel like remember back in the heyday of the Tonight Show when Johnny would invite a guest back a second time? It was kind of like a coronation. So I'm very honored.
Eventually, I'll invite you to come sit next to us here at the in the Bennett Studios of Invest with Rules.
Would love to, love Denver. Yeah, I always love to go to Denver.
I want to start. So we're going to cover trailing stops today, but I want to talk about. I've always liked to look at the macro headlines. I think it's really important to focus on the big picture and to be self-critical. I always like to focus on what the Fed's focusing on, which is jobs, interest rates, inflation, geopolitical risks, and contagion, this kind of domino effect. But I've always felt that it's been a little bit um, maybe not as organized as I would love. And I found a framework from a guy named Michael Kantrowitz. I believe he works at Piper Sandler's my thinking. I put a link to his HOPE framework. HOPE stands for housing activity. O is for orders. Think manufacturing and the growth of the industrial complex in the United States, and then just in general how things are growing in general. And then three, the P, so HOPE, the P is the profit cycle. Are corporate earnings and corporate sales growing or decelerating? And then finally, you get to the employment contracts. So instead of focusing on employment first, which according to the HOPE framework, which I think is really interesting as just a framework to overlay as data comes at us, is the first thing to slow is typically the housing sector. Then comes the new orders sector. Then comes profits. Finally, employment's a lagging indicator. So the challenge of this housing cycle has certainly been that people who have been in their home for a long time have very low interest rates that are politely stuck and just kind of maybe do small projects versus massive moves. But I think having a process to kind of maybe just organize our thoughts is really important. Just Mike, any general comments on the macro analysis here at Invest with Rules?
Yeah, I love it. I guess the only thing I'd ask is the fact that housing's been perking up of late. What does that tell us in that macro view?
Yeah, it's a good question. So obviously the home builders have been doing really well and they've been on our radar. And there's been a couple that have been over the last several months on our billion-dollar fund manager report. But they used to make up a really small amount of the real estate transactions, somewhere in the neighborhood of 10%. Today they're more like 30%, somewhere in the 20 to 30% range. So we're going to continue to focus on housing, even though it's kind of changed as when you walk around your neighborhood you're seeing houses on the market a little bit longer than normal. And maybe as the Fed just bazookaed us with a 50 basis point rate cut, maybe that will move a little bit quicker as we're seeing a lot more activity. And then here's the thought. They're going to meet again, Jerome Powell and friends, in November. And right now we're at this, they give you a range for the federal funds rate. We're at 4.75 to 5 is where we're down to now. And the bazooka is actually maybe another 50 point point rate cut is coming. 62% probability that's coming in November. So the market's pricing that in, and the market obviously likes it. And that's why we are, from a macro and from a trend following perspective, we're at 10 out of 10 on the market health score. We are really invested in the left lane of the highway. Any comments there? That's kind of what the macro view is showing.
Yep. Makes sense.
Love it. So let's jump into this. So we had a really good question from Jack, a new member of Invest with Rules. I thought it was a really good topic, so we'll hit it. But it's mainly around stop losses, trailing stop losses, average true range, and this is right up Mike's alley. So we'll tag team this together. But just in general, our trend following system. So follow the trend, follow big money, follow risk management rules. Following the trend is kind of the first stop on our adventure. And very simply, we are looking at four stages. We have a basing stage, which typically comes after a disastrous stage 4 decline. This is what we call a U-turn. This is where the short-term trend is up, the long-term trend is not there yet. The stage 2 is where the market is today. So we are happily enjoying the profit cycle. We have a short-term, long-term uptrend. We're not overheated yet, so that's why we're pretty extended in regards to our exposure to the markets. We can see these topping patterns where the short-term trend flips to downtrend. That's a stage 3 topping pattern we call a coast. At that point, we're at this pivotal moment where do you go back to a stage 2 or do you fall apart? And the macro picture obviously showed that the Federal Reserve was really concerned about a slowing growth, slowing inflation. So they shot us kind of politely back, is what they did. And that's why we are fully exposed in the markets, is our trend following system. So we're not in a break, we're not on a coast, we're in this gas signal environment. So when it comes to our trailing stops and our risk management, we will apply some of that in regards to the trend. Anything I missed there, Mike?
No, I think you hit it.
Okay, love it. So let's get into some of the meat and potatoes. Mike, why don't you start us off on this trailing stop loss, buy engine, sell engine kind of overview?
Yeah, absolutely. So this graphic here just basically summarizes what Scott's talking about, and it also ties into some of what we did with the 2.0 update of the trend roadmap that we rolled out about a month ago. So just to hit this chart kind of step by step, you've got on the left-hand side what we call the buy engine. You know, what are you buying and why you're buying it, when are you buying it? And then it morphs over to the right-hand side, the sell engine, really, you know, managing the trade and when do you sell. So starting off on the left-hand side, first step of the 4 steps is identifying the ticker. You know, basically, I like to call it the pond. What pond are you fishing in? Where are you getting your stock tickers? Where are you getting your ETF tickers? In the case of investment rules, obviously with our stocks, we're getting it from the billion-dollar fund manager list. That's our pond. And from a list of about 80 ETFs that we've honed down over the years and focusing on 80 ETFs to be our pond of ETFs. And then we use trend roadmap signals, the 2.0 signals, to then decide, filter down further from that pond to say, okay, here's what we're going to go with. Once we do that, we then go to step 2, which is assessing risk. And we never want to buy something that's got a really awkward risk to reward profile. And our general rule of thumb that we laid out here is for level 1, we want to go in with a risk of about 4 to 6%. Let's call it 5% ideally. Level 2, 6 to 8%. Less is better, but 6 to 8%. And then level 3, being individual stocks, we give those a bit more room, bit more risk, so 6 to 10%. Does that mean that we never go outside those bounds? No, we do sometimes, but that's our rule of thumb. So we step 1, find the ticker. Step 2, assess risk. Then we go to step 3,
Before
the
you do that,
actual trade and assigning the trailing stop loss.
can I jump in
So,
really quick, Mike?
oh, by the way, yeah, go ahead, Scott. Yeah,
So when you're looking at the live sheet, you
yeah,
meaning us and our members. So
yep,
right now, what I see a lot is like, let's take one topic like semiconductors. So at the top level, you'll see like the ticker SMH or SOXX, which are a basket of semiconductor stocks, a
yep,
weighted percentage. And those ETFs, those exchange traded funds, as this might be rudimentary for some, but they have a very small expense ratio, but you're buying a basket. If you keep scrolling your eyes down when you look at the live sheet, sometimes you'll see stocks such as ARM, which is in our level 3,
yep.
ARM Holdings. You'll see NVIDIA. You'll see Marvell potentially, and you'll see all these tickers. So the question is do you mentally kind of globally want to own just the basket, or do you want to own the company? And obviously, when you go to just one company, you're going to get some more what they call idiosyncratic or just one company risk. So
Mhm.
we give it a little bit more of a band of risk, of acceptability of risk.
Yep, absolutely. And really it's up to each trader and investor to decide where they want to go. So it's okay to be a total ETF investor or trader. It's okay to be a total stock trader or do both like we do.
Cool. Okay, so part three.
All right, so part three is, and this is where the trend roadmap comes in and the 2.0 update that we did. So now what we're able to do with 2.0 is unlike 1.0, we're now able to anticipate the actual stages. Now, nobody knows the future, so it's not exact, but we're able to estimate the kind of when an uptrend's going to end, when a downtrend's going to go to an uptrend, et cetera. And we use that to set the trailing stop loss. And one piece of advice, it kind of fundamentally that I think, Scott, you totally agree with me on is nobody should ever buy something without a stop loss. Knowing, even if it's not a hard stop loss, put in with your broker, at least knowing when you're going to say this trade's not working, I'm out of it. That's part of basic risk management. That makes sense, Scott?
Yeah, and not only does it make sense, but I would say something really important is the fact that um, if you don't have a mental or a hard risk, the market will politely mentally destroy you.
Yeah,
And I say that with all sincerity from personal experiences. In my trading and investing career, you just don't want to go in too hopeful and blind because the market has a polite way of taking your money, and we just don't want that to happen to you.
absolutely. Absolutely. Yeah, and we've touched on it before and we'll touch on in the future, a lot on trading psychology, investor psychology. It's huge. It's such a big part of this. So on step three, what we do is when we go to buy something, we know what stop loss we're going to assign to it. If we happen to be able to get into a trade where we could assign a long-term trend signal stop loss, and we'll explain in a minute why that's important, but that's what we'll do. So the four main stop losses that we use are using the long-term trend signal, which is we're trying to ride those winners for a long time. The second one is a short-term signal, which is kind of more that trader psychology, but sometimes we have to go into a trade using a short term because of risk, because it's smaller percentage risk. The next one is what we call midterm. It's just an approximate between the two, long term and short term, in case we need it. And then the last one is ATR. And this is the question that actually one of the questions that Jack asked, who our new member who kind of spurred all this on is what about ATR? We happen to use an ATR is average true range of what a stock does in any given day. Say it's a 2% ATR. So that means that stock on average moves plus or minus 2% in a day. And we then multiply that by 2.5 times. Where we come up with 2.5 times, it was just based on back testing and it's a bit arbitrary. But we very seldom use the ATR stop. It's only when nothing else fits. So if it's a 2% stop, 2.5 times that is essentially 5%. So we'll use a 5% trailing stop, 2.5 times the ATR. Then once that's set, that's the initial stop loss. So we put the trade on, we know what our stop loss, our exit point is going to be in case the trade falls apart, and that leads into step four, managing the trade. Scott, anything you wanted to jump in there on that I missed?
Yeah, my comment would be it's a lot of it's when you buy. So if you think about like
Yep.
a cup formation, a lot of the time, a lot of investors are trained to buy the breakout. So after it's already hit the bottom, it's already rounded, it's already coming off the top. If you buy breakouts and you use too loose of a trailing stop, it's going to be pretty painful.
Yep.
So if you were to buy lower in the range, which is what we tend to do when the short-term uptrend happens, then we can adjust that based upon our known percentage risk. So we're just a lot of the time what we're doing is we are using a trailing stop loss of these four based upon where we're entering the position. Is that fair?
Yes,
Okay.
definitely. Yeah. And the lower, the smaller the percent, the better. and the longer time frame, the better. And we're going to hit that in just a minute. We got kind of a good little summary box that tells us why. But then that leads to managing the trade. So as we manage the trade and as we're in it for a lengthy period of time, let's talk about BSX being the longest position we've been in now for a year plus. Well, that we want to achieve using a long-term trend signal if we haven't already in the initial trade, or the road tripper. And what's the difference? The road tripper is when we have a significant gain and we want to capture at least 60% of that gain and not give everything back. The long term is essentially using that long term signal. And sometimes one is greater than the other. And that's a discretionary pick of which one you go with, depending on where the position's at. But Scott, if you could, yeah, there you go. Perfect. That
Yeah.
little pop-up box we just brought up is why do we want to achieve the using the long-term trend signal for the stop loss? Because it leads to less trading because we're using that, we're giving that trade a lot of room, that ticker a lot of room to move. The second is that leads to bigger gains, hopefully. So in the case of BSX, where we allow BSX to kind of breathe and continue to increase our gains. And then lastly, it oh, sorry, Scott, could you just flip back one?
Oh, sorry.
Yeah, and also allows us to achieve long-term capital gains. So that's really key where, especially if you're in a taxable account, is for taxation, achieving that long-term capital gain if you can. Yeah, go ahead, plow forward.
Yeah.
Now,
So I want to
yeah,
hit
go
the
ahead,
Amazon
please.
example.
Yeah, absolutely. Yeah, Amazon's a great recent example. So with Amazon, we put on just recently, it was such a great trade because we were able to go into it with a long-term stop at a 10% risk. It was about 10%. That's ideal for a level three. That's within our range. It's Amazon, billion-dollar fund manager stock. And actually, I misspoke. It was actually an 8.4% initial risk, even better than 10%. And so we automatically go into Amazon using the long-term goal trend signal. And now it makes managing that trade, the Amazon trade, a lot easier because we don't have to change up stop losses until we get to road tripper status, which is going to be 3 times our initial risk. In this case, 3 times 8.4, approximately 25%. We achieve that on Amazon, we can flip the road tripper stop losses if we want to. Scott, fill in any gaps I left there, please.
No, let's just do a couple more kind of visuals. So just simply when you're entering a trade, so we're assigning a stop loss. So whether it's short term, kind of initial, midterm, or long term, where we're entering is
Yep.
kind of the way to think through this visually. And again, typically it works in this fashion. We're assigning a road tripper for our larger gains, and there's nothing worse in this world to make a ton of money and give a ton of it back. So we're trying to we have a strong process to retain a large majority of our gains. And then let's go through two quick examples. So let's start with BSX. So here's the trend roadmap chart of BSX. We've been in this one a long time. It's a medical device company. Right now it's on a gas signal. This was yesterday on a short-term and long-term uptrend. The funds have been moderately accumulating. Here's a weekly chart of BSX. So we've been in this trade for we're upwards of 50, 60% gains. So at the very top line in red, we have the short-term trailing stop, which we're not using, but just kind of interesting where it is. We have the midterm trailing stop. We have the road tripper stop. And then finally, we have the long-term trend, which we want to retain 60% of our profits roughly, or to kind of think of it as 3 times our risk unit. And over time, as this thing hopefully keeps climbing, then we have this road tripper mentality, which is amazingly right below the tail of this weekly bar, which is kind of pretty interesting. We were able to buy this somewhere down in here. So I believe. So in general, all this has been working appropriately, and you can kind of see where the long-term trend is as well. Let's say hypothetically Boston Scientific falls apart. It's just we have known risk. And anything you'd add here, Mike?
Yeah, and in this case, we're using the road tripper because it's significantly higher than the long-term trend stop. and we want to preserve those gains. So the road tripper is where we have BSX situated right now.
Okay. And I'll do one more example. This is Axon, so the artist formerly known as Taser. It's in an
Yep.
overheat right now. Uptrend, uptrend. The funds give it a B for strong accumulation. So obviously this has been a nice jump after earnings. And here's a weekly chart of Axon, AXON. This one's kind of interesting. So you have the short-term trailing stop kind of right at the highs of this base breakout where that earnings happened is that, call it 3 weeks ago. The road tripper, since we are kind of, this is a relatively new position, but it is up almost 30%. The road tripper is just tucked in underneath. And then you have the midterm signal, which is at the top of this base, interestingly enough. And then the long-term trend is at the bottom of that base breakout. Anything to add there?
Yeah, and the interesting thing is going to be, assuming Axon continues to act well and trend up, we're going to see these stop losses, these trailing stops kind of adjust. And the goal is that the road tripper expands to give us more room. That's the only thing I'd add, Scott.
Love it. So we want to hit that quickly. Obviously, if you have questions, we'd love to hear from you all.
Yep.
We're here for you. We care about you, and we are just kind of hyper focused on this on a daily basis. Other things on the live sheet today that just stuck out. Obviously, the market's doing really well. We have a lot of gains in almost all three levels, which is great. There's a potential trailing stop might get hit in level two. I was looking at healthcare this morning. If that does happen, very simply, we will move to another uptrend that has opportunity. So we follow the process. We politely cycle through searching for uptrends. So if we do move to our stops are hit, or we move from gas to coast, or we'll call it that stage two advancing to kind of topping phase, we have lots of merchandise. We are not falling in love with these tickers unless they are treating us incredibly well. We have wonderful gains, and then we're able to kind of maneuver our stop losses as we just recently showed on BSX and Axon. So before I sign off, again, thank you for your time. Mike, any final words?
No, you hit it. And thank you very much. Really appreciate all being members. Really appreciate it.
Awesome. Again, talk soon. See you on Friday. We will be on the live sheet. Have a good day. Bye-bye.